Today we are running through 3 stocks on my wish list. I'm going to run through the companies and look exactly what it is I like about them, running through their financial metrics, their dividend metrics, their historical performance, and we are going to look at them in the stock valuation model, getting to their intrinsic value, and I'm going to specify what price I am targeting them to accumulate shares, what my margin of safety is, and what the acceptable buy price is alongside Wall Street's analysis. So let's jump straight into the video, and the first essential company is UNH, United Health Group. Now this is an American multinational managed healthcare and insurance company. Year to date it is up around 5.5%, and we can see it right there at that 52-week high. They do offer a yield of 1.4%, and investors who have been holding the company over the last 10 years would be up a phenomenal 635%. Remember, that doesn't include those dividends reinvested. So what exactly do I like about this company? Let's take a deep dive into their metrics. Well, dividend safety score, firstly 99, it is very safe. Market cap 506 billion, and they are a mega cap company. Now some recessionary metrics, as we tend to do on the channel. They did maintain their dividend during the last recession 07-09. They had positive 5% sales, which, remember, it is above the average growth of companies in the S&P 500, which was negative during that period. But they did unfortunately have a negative 63% return, which underperformed the S&P's 55%. Well, the first thing I love about this company are those double-digit increases year on year. 14% this year, 17% over the last 5 years, and an incredible 40% over the last 20 years, which far exceeds that inflation rate of 4% that I always advocate on the channel, whether that's your dividend, salary, or other income-producing assets. They've also increased the dividends over the last 13 years consecutively, but when we do take a look at dividend yield theory, we can see that it is roughly reasonably valued. Remember, dividend yield theory states that the company is undervalued when that current yield sits above the 5-year average. Forward PE roughly in line with the 5-year average, 20.2 versus 19.8, and the sector PE is 16.4, significantly lower than UNH's 20. Now remember, it is at the 52-week low, but as I always say, 52-week low does not signal overvaluation, but I will give you what price targets I am looking for this company I do wish to add. Remember, we always focus on the free cash flow payout, as earnings is susceptible to manipulation by management through accounting. Another metric that I do love about United Health, well, they have their dividend free cash flow payout well below 60%, which is the maximum I like to see, as I believe management can offer those double-digit increases. And lo and behold, it's well below 60%. In fact, below 30% every single year, with 2023 expected to be again in the mid-20s. So that is very positive to see. Again, free cash flow per share, significant growth over the last 10 years. $5.65 to $25, more than 4 times growth on that free cash flow. And look, we can see 2023 expected to be even higher. Now that is strong, consistent growth year on year. Sales growth, well, wow. I mean, double digits nearly every single year to their top line, well above that inflation rate, well above that moderate growth of 3 to 7% that we do tend to target as a minimum for companies. Numerically, well, how does that compare? 122 billion, nearly 3 times growth over the last 10 years to 324 billion. And it is nice to see they also return excess cash to shareholders' pockets. 1.02 billion shares outstanding, with buybacks over the last 10 years, taking it to 950 million. ROIC above that minimum 10% I look for. We can see 18 to 19% consistently year on year, trading 12 months showing 20%. Remember, I do look for 10% or more, as it gives me faith management are able to effectively allocate their capital. Operating margin, probably one essential red flag indicator for me. It's not something I do like. The operating margin is consistently lower than 12%. We do see it typically between 8 to 9%. On the other hand, the free cash flow margin around that 5% or more target that we look for, consistently around that 6 to 7%. Net debt to EBITDA, very, very strong. Remember, this does correlate to that dividend safety. EBITDA standing for earnings before interest, tax, depreciation, and amortization. And this shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 1.04 in 2022. It is expected to go below 1 in 2023, showing the company's very strong balance sheet as well as that very strong dividend safety score. So it isn't one that I am adding to my portfolio now. It is one that I do actually hold, but it is also one that I want to continue to add at the right price. Now, typically on the channel, we have the stock valuation model where we run through every single model. We have Graham's valuation, we have multiples valuation, dividend discount model, the DCF model, and then we get to our intrinsic value. Today's episode, we're going to jump straight into it. And for those that are new to the channel, we sometimes do remove some of these valuation models for which we explain directly in those videos. So the intrinsic value for UNH is the average of these three models, coming to $606. Now, the current price is around $547. And we can see margin of safety. What do we normally do? Well, we typically start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, for me personally, I could argue that UNH does have those targets. You could explain and reason for a 10% margin of safety. Personally, I would go higher. Those looking at a 15% margin of safety would be a buy around 515. And those looking at 20% would be around 485. Now, for me, somewhere in the range of 15 to 20% is where I would be looking to add additional shares of this incredible company, which I do love, for both the aspect of share price appreciation as well as dividend growth that we saw. So as soon as it comes under 515, around the $500 mark, I will be dollar cost averaging in, as we can see, between 15 to 20%. So I will start making some small buys at around 515, and if it does continue to grow lower and lower, I will add significantly more. Now, Wall Street, they believe the share price to go up to around $593, slightly lower than our intrinsic value, but they do believe there to be some very strong growth within this company over the next 12 months. This then takes us to the second stock on my watch list, which is Costco Wholesale Corporation. Now, for those that don't know, they are effectively operating a chain of membership-only big box warehouse retail stores. Year to date, phenomenal performance, up 30%. They are again up at that 52-week high, a common theme for stocks that I do wish to add. Yield not the highest at around 0.69%, and for those that have been investing for the last 10 years in Costco would be up an incredible 418%. So let's take a look at some very strong financial metrics from Costco. Straight away, dividend safety 99 score, market cap 262 billion, so they are a mega cap company. Now again, recessionary metrics, they increased the dividend during the 07-09 recession. Negative 1.5% recession sales, but it was above the average growth, which was just negative to a larger degree. And we see a recession return outperforming the S&P's negative 55%. Dividend growth, well, double digits this year, double digits over the last 5 years, double digits over the last 10 years. Incredible to see. And on top of that, one thing to mention is they do every few years pay a special dividend. Now, in terms of dividend growth streaks, 19 years, 25 years will make them a dividend aristocrat, which they are well on their way. Now, dividend yield theory does show you could argue reasonable valuation / slight overvaluation, and we can see the forward PE slightly higher than the 5-year average, as well as the sector PE significantly lower than Costco's forward PE, which is why I will be looking to add this when the price comes down, and we will touch upon that price target shortly. Free cash flow payout, well below the 60% I look for. In fact, well below 50% every single year bar 2016. 23 at 25%, 2024 expected around the same, so very strong, and I do expect another double-digit increase next year. Free cash flow per share, well, $4.54 in 2014, more than 3 times growth over the last 10 years to $15.12, so very strong. They're not very consistent year on year, but over the long term, they are moving in the right direction. Sales growth, it isn't double digit every single year, but overall I would say this is a strong company which do grow their top line very, very well and well above that 3 to 7% that we look for as a minimum. And numerically speaking, we can see they've more than doubled their top line over the last 10 years, 113 billion to 242 billion. Shares outstanding essentially flat over the last 10 years, very minimal share buybacks or share issuances, so nothing to touch upon there. ROIC, again, a common theme of companies I invest / look to invest in above that 10%, with the last 3 years in the mid-20s. And when we look at the margins, now we can see, again, for companies that do operate in this industry, the margins are a very, very, I would say, very difficult time for them to essentially increase those margins as consumers are being hit. But we can see, in fact, over the long haul, their margins have been relatively small at 3 to 4%. So this is something that is fairly consistent for the company. But both operating margin and free cash flow margin is one of the areas that, for me, Costco does make it a slight red flag indicator. But nonetheless, not every company has exemplary metrics all around. Net debt to EBITDA well below the three that we look for. In fact, other than 2015, 2017, it is zero. So again, a very strong balance sheet. If they wanted to, they could pay off all of their debt on the same day. Now, stock valuation. Remember, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. So the intrinsic value coming to $601, you could argue not far off the current price of $591. Now, margin of safety, we will start off with 10% as we normally do. And you could argue that Costco does have a wide moat, strong financial metrics, and good forward-looking data. But personally, I would be looking for a slightly larger margin of safety. The one thing that does worry me with Costco are their margins. But one of the things that you have to remember is to go into a Costco shop, you do need to pay for a membership. And the membership continues to increase. So all Costco need to do to increase their top line, other than their products and services, is just to increase that membership, whether it's $1 or $10, that it will take a significant positive impact to their top line. So I would be looking very similar to UNH, between a 15 to 20% margin of safety for Costco. So I would start to add when it does start to come around that $500 mark and below. And as we can see, when we do take a look at Costco, in terms of their last 52-week range, that is still well within that 52-week range period. Now, what do Wall Street say? Well, they believe the share price to go around pretty much to our intrinsic value. So they do believe over the next 12 months, that is the highest it will go. And it do seem to be some signs of overvaluation currently. Now, the third stock that I am looking to add to the wish list is Visa. Now, this is a payment card service company. Year to date, very strong, up 23%, right there at that 52-week high with a yield of 0.82%. Investors who have been holding this company over the last 10 years would be up a very strong 399%. Now, a very quick rundown of their metrics. Again, very common theme here. Dividend safety, 99, very safe. 511 market cap, making them a mega cap company. And if we look at their recessionary metrics, increased during the 07-09 recession, plus 9.5% sales, which is positive to see. Dividend growth, a very similar story. Double digits this year, double digits over the last 5 years, and surprise, surprise, double digits over the last 10 years. They have been paying increasing dividends for the last 15 years, so it is very positive to see. Now, dividend yield theory, we can see they are undervalued based on this, but we never ever conclude on one model, 0.82% versus 0.67. And we can see the forward PE is still significantly lower than the 5-year average. When we do a sector PE comparison, though, that is significantly higher than the financials. Now, again, when we take a look at that free cash flow payout, again, a very, very similar theme. If I was an investor here, I would be noting down all the themes that we do spot with these high quality companies. So when we do our research, we can tick off whether or not they hit these criteria. Free cash flow well below 60%, in fact below 30% consistently, and over the last few years below 20%, with 2024 expected again to be around 20%. Free cash flow per share, very, very strong, 266 in 2014, 962 in 2023. Very nice growth. The trajectory is moving in the right way. In 2024, again expected to go even higher. A very strong business. Double-digit growth over the last 10 years, fairly consistently. We see that COVID year of negative 5%, but the 3 years that have preceded, or the last 3 years, in fact, double digits. And on the numerical basis, 12.7 billion in 2014, 33 billion in 2023. So we can see nearly 3 times growth on the top line. And if you want another positive metric, well, they're also putting excess cash to shareholders' pockets by buying back shares from 2.52 billion to 2.09 in 2023. The good metrics don't stop there. Return on invested capital well above the 10% minimum, with the last few years in the 30%. And again, it doesn't stop there. The free cash flow margin, operating margin, this is a very, very strong company. In the mid-60s on the operating margin, free cash flow margin again in the mid-60s or low 60s over the last few years. There isn't really too much that you can fault with the company if you put the valuation to one side. Net debt to EBITDA, again in 2023, it would take them 0.05 years to pay off all of their debt net of cash on hand. An incredibly strong balance sheet as well. So let's jump into the valuation model. And as always, if you do enjoy the content, value is being provided, smash that like button, hit the subscribe. It helps the channel grow, helps this video get pushed out to other investors like yourself. Now, the intrinsic value coming to $280 with the current price at $254. Again, we always typically start off with 10%. So this would essentially say that right now, roughly you are getting a 10% margin of safety for Visa. Now, if we do increase this to 15%, it would come to 238. And if we do move this to around 20%, it would be around 225. Now, personally, I do believe that if there are chances of a recession coming in 2024, then we could expect to pick these shares up at lower than they are currently trading for now. So for me, I would be waiting for around a 25% margin of safety for Visa, which is sitting around $210. But I will start to dollar cost average from around 20% at 224. So I'll do a few buys at 224, and then when I do see this, if it comes down to that 25% at 210, I will be adding more. Now, Wall Street, what are they forecasting? Well, they believe roughly in line with our intrinsic value at $280 for the price hit over the next 12 months. Remember, as always, though, we never copy what Wall Street do. We always have to do our own due diligence. And don't forget, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, or if you want to run through any of these we did today but go through the numbers, then do click on that pinned comment. Finally, drop your comments below. Let me know whether any of these are on your wish list, or let me know what other stocks are on your wish list and at what price target you are looking for, whether it's these that we have run through or other ones that are just in your watch list portfolio. As always, have a great day. Don't forget to like and subscribe if you've enjoyed the content. Don't forget to click the pinned comment to grab a copy of the stock valuation model. And as always, just have a great day and catch you on the next episode. Take care.